In this chapter, we will talk about taxes that employers must pay. These taxes were not withheld from employees because these are the responsibility of employers. These taxes are unemployment taxes for federal and state, Social Security tax, and Medicare taxes. The employers are required to pay these taxes. Unemployment tax. This is a tax that's imposed, again, on the employers only. Money is paid into this fund that provides unemployment insurance. Any individuals out of work at no fault of their own, such as a laid-off, may qualify for unemployment compensation, financial assistance from the federal government. The tax is based on taxable earnings of the employees. A 6% tax is imposed on the first $7,000 of employees' taxable wages. Any amount of income above the $7,000, the employer will not have to pay FUTA tax on it. Employers also have to pay state unemployment tax, and because they have to pay state unemployment tax, they may receive a credit, which is kind of like a discount from the federal government, and this credit is 5.4%. And with this 5.4% credit, it reduces the federal unemployment tax from 6% to just 0.6%. Certain states and U.S. territories may be subject to a credit reduction. So instead of getting a 5.4 normal credit, the credit will be reduced. It will be less than 5.4%. For example, U.S. Virgin Islands have a credit reduction of 2.7%. So instead of getting a credit of 5.4%, it is reduced or lowered by 2.7%. In other words, for the states and territories besides the U.S. Virgin Islands, the normal FUTA rate is 6%, and then there's a credit of 5.4%, hence a FUTA rate of 0.6%. However, for U.S. Virgin Islands, they do not get a credit of 5.4%. This credit is subject to what's called a credit reduction. So 5.4% is reduced by 2.7%, the credit reduction of 2.7%. So 5.4% reduced by 2.7%, you have 2.7% as the credit. And so you take the 6% FUTA rate minus the credit that the U.S. Virgin Islands get, only 2.7%. Then the FUTA rate comes out to 3.3%. So they have to pay a higher FUTA tax rate, a 3.3%, instead of a normal 0.6% like other states and territories. We now know the FUTA tax. What about the FUTA tax payments? FUTA tax must be remitted by the employer 4 times a year, quarterly. The only exception is that when the total FUTA tax owed by the employer is less than $500, in this instance, the employer may postpone the applicable payment either until the total tax owed exceeds $500 or until the end of the year. When FUTA taxes exceed $500 at the end of a quarter, they must be paid by the final day of the first month after the end of the quarter. As a result, the 4 payment dates for FUTA tax during the year are as follows: April 30th, July 31st, October 31st, and finally January 31st.